While most people had no idea what a GPU was, a few engineers at a company called Nvidia were slowly building the future. A future that is now controlled by the same company. Nvidia is the king with a 90% share of the GPU market, a dominance that made Nvidia the first company to hit a $5 trillion market cap. I'm SK and today we are dissecting Nvidia stock, a beast who is at the core of the AI revolution. Nvidia surprised everyone by adding $1.3 trillion to its market cap in 2025. Wall Street analysts think it has still room to go higher, and they showed their confidence by giving it an average price target of $260. That's a 40% upside. The question becomes, is it going to continue its rally or is a huge correction incoming? Let's analyze Nvidia against my 6-factor framework to see whether it has what it takes to deliver on the promise. Starting with Nvidia's business model. Founded back in 1993 by Jensen Huang, Chris Malachowski, and Curtis Priam, Nvidia was born in a humble Denny's restaurant booth in California with just $40,000 in seed money. These three engineers from companies like AMD and Sun Microsystems saw a gap in the market for advanced graphics processing. Their first big hit, the Riva 128 chip in 1997, which revolutionized 3D gaming on PCs and put Nvidia on the map against competitors like 3DFX. By the late 1990s, they launched the GeForce line, powering everything from Quake to early console deals with Microsoft for the Xbox in 2001. But the magic happened in the mid-2000s. They pioneered CUDA in 2006, a software platform that let developers use GPUs for general-purpose computing beyond just visuals. This was a game changer, positioning them for the AI boom. Fast forward to 2010s, as deep learning exploded with frameworks like TensorFlow, Nvidia's GPUs became the gold standard for training neural networks. Remember the 2012 AlexNet breakthrough in image recognition? It ran on Nvidia hardware. By 2016, data center revenue started surging, overtaking gaming as the core driver. Today, in 2026, Nvidia is a full-stack AI enabler, from chips to software to systems, with a market cap around $4.5 trillion. Making it the world's most valuable company. Now let's look at their revenue streams. Nvidia is diversified but laser focused on high growth areas. The biggest share, about 89% in the latest quarter, comes from the data center segment, which bought in $51.2 billion in Q3 fiscal year 2026. This includes sales of Hopper and Blackwell GPUs for AI training and inference, plus networking gear like InfiniBand switches. Hyperscalers such as AWS, Google Cloud, and Microsoft Azure are dumping billions into AI infrastructure, and Nvidia captures 80 to 90% of that spending. Gaming contributes around 7 to 8% or $4 to $5 billion quarterly, while GeForce RTX cards and cloud gaming services like GeForce Now. Gaming revenue is still strong but maturing amid console competition. Professional visualization adds 2 to 3%, powering workstation for design pros in film, architecture, and engineering. Automotive and robotics bring in 1 to 2% of their revenue, focusing on self-driving tech like drive-oriented platforms for companies like Tesla and Mercedes. Autonomous vehicles are a sleeper hit with projected $10 to $15 billion potential by 2030. Overall, revenue is hyper-concentrated on AI, but this diversification hedges against slowdowns, unlike AMD, which has more balanced but slower growing segments. Let's also look at some of their major business decisions. Nvidia has made some bold moves that define their dominance. First, the 2019 acquisition of Mellanox for $6.9 billion, integrating high-speed networking into their stack, creating AI factories that bundle compute, storage, and connectivity. Second, their annual chip cadence, launching Ampere in 2020, Hopper in 2022, Blackwell in 2025, and now Rubin, which is due in second half of 2026. Each generation doubles efficiency, keeping the rivals chasing. Third, building the CUDA ecosystem. It's not just a tool, it's a community with over 5 million developers, allowing them to use GPUs for non-graphics tasks like AI and scientific research. Fourth, pivoting to sovereign AI, deals with nations like Japan and India for custom data centers, dodging US-China tensions. And fifth, aggressive R&D spending of $10 to $12 billion annually, fueling innovations like Omniverse for digital twins. Compared to AMD's more fabless focus, Nvidia's full-stack approach gives them pricing power and margins north of 70%. I'm rating their business model a solid 9.5 out of 10. They have the monopoly and would probably retain the throne for years to come. Now, factor 2, financial performance. Even great models mean nothing without numbers backing profitability and growth. Last year for Nvidia had been incredible. In the first 3 quarters of fiscal year 2026, they did $147.8 billion, with margin expansion driving unprecedented earnings. Looking at the year-over-year revenue trends, in fiscal year 2024, they reported $60.9 billion. In 2025, that grew to $130.5 billion for a 114% increase. And for fiscal year 2026, they are projected to generate $212.8 billion, $147.8 billion so far, and estimated $65 billion in the fourth quarter, marking a 63% rise. Their revenue has more than tripled in the past 2 years. Fiscal Q3 2026 delivered $57 billion in revenue, 62% increase year over year. alongside diluted EPS of $1.3, surging 67%. Their gross profit has grown to $41.8 billion, a 23.6% increase quarter over quarter. Net income increase is also above 20%. Operating margins hit 66.2%, with free cash flow at $22.1 billion, a 64% increase quarter over quarter. Q4 guidance points to approximately $65 billion in revenue and an EPS of 1.44. CEO Jensen Huang projects that global AI infrastructure spending will reach between $3 to $4 trillion by the end of the decade. And Nvidia, being the leading provider of AI chips, is best positioned to capture most of this investment. Balance sheet signs with the total assets growing to approximately $161 billion, with total liabilities staying under one-fourth of this total assets at $42 billion. This leaves their shareholders' equity at approximately $119 billion. Their Q3 2026 current ratio is 4.47, which is extremely good, showing strong short-term liquidity. Their debt-to-equity ratio is 0.36, indicating the company's low reliance on debt. The only concerning thing is that it's currently trading at 38 times its EBITDA, which would have been highly overvalued in pre-AI era, but this somehow makes sense to majority of the investors in today's time. I give their financial health a 7 out of 10. The company has solid fundamentals and insane growth potential, but currently it is trading at a premium future-adjusted price. Moving on to factor number 3. Nvidia is the undisputed champ in the AI ring, holding a massive 90% stake of the GPU market. But competitors are slowly catching up. AMD is a main competitor with MI300 and MI400 chips, along with upcoming MI450 release in the second half of 2026. AMD offers lower prices 20 to 30% cheaper than Nvidia. AMD's ROCm software is open source, which helps attract users who want flexibility. AMD has 8 to 10% share in the data centers. Nvidia responds with better scale and performance to win large contracts. Then enters Intel, a veteran trying a comeback. Their Gaudi 3 chips shine in inference, running training AI models efficiently, but they lag in raw training muscle. Intel's betting on volume and integration with their Xeon processors, appealing to enterprise folks who want everything in one box. It's a slow burn. They're not toppling Nvidia overnight, but chipping away at niches like edge computing. Now the plot twist. The real villains aren't traditional chip makers. They are the hyperscalers building their own chips. Google's custom-built ASICs called TPUs, Amazon's Trainium and Inferentia for cloud-specific tasks, Microsoft's Maya and Meta's MTIA. These custom ASICs are tailored for inference, consuming less power and costing way less than Nvidia's general-purpose GPUs. Imagine if these hyperscalers started selling their custom chips to third parties. Gartner predicts these could steal 20 to 30% of the inference work by 2028. New startups are also gaining ground. Groq's LPUs are specialized chips designed for high-speed, low-latency AI inference, particularly for LLMs. Cerebras has wafer-scale engine, the world's largest and most powerful artificial intelligence processor, designed to accelerate AI training and inference by using an entire silicon wafer as a single chip. Now, let's look at how Nvidia stands against the PESEL framework. Politically, issues like ongoing US-China trade tensions that have led to export bans on advanced chips, cutting potential sales by billions and risking supply chain disruptions from Taiwan, where key partner TSMC is based. Though US subsidies from the CHIPS Act help build more domestic production. Economically, the massive AI spending boom from big tech companies is set to hit $400 to $500 billion in 2026, driving huge demand for Nvidia's products. But if a recession hits and GDP growth dips below 2%, businesses might cut back on investments, even if AI returns remain strong. Socially, AI exploding in popularity, and everyday tools like chatbots and image generators pushing more adoption in areas like agentic and physical AI. While public concerns over job losses and biases could lead to calls for stricter rules. Technologically, Nvidia's proprietary CUDA software gives it an edge, but open alternatives from rivals are gaining ground. And the upcoming Rubin platform in late 2026 promises an even better efficiency to stay ahead in fast-evolving tech. Legally, there's growing antitrust scrutiny from regulators like the DOJ over Nvidia's market dominance, like cases against other tech giants, plus ongoing IP lawsuits that could tie up resources. Environmentally, data centers powered by Nvidia chips consume tons of energy, contributing to global power usage, so the company's focus on making Blackwell and Rubin chips 30% more efficient helps meet ESG standards and supports partners' net zero goals like AWS aiming for 2040. Overall, Nvidia's position is strong, but cracks are building. I am rating their competition and external factor a 7.5 out of 10. The competition is quickly building, and if hyperscalers like Google, AWS, and Microsoft decide to jump into the GPU market, Nvidia's stake could easily drop 20 to 30%. Moving on to technical analysis. While this isn't the be-all and end-all for long-term investors, it's a fantastic tool for timing your entries and exits by looking at the price action. The key is to keep it simple. As of Jan 16th, the price is hovering around $186, up around 10% from its recent support at $170. Over the past 52 weeks, it's ranged from a low of $87 to almost $210, showing the massive potential of this beast. From a chart perspective, the stock is trading above both the 50-day moving average and the 200-day moving average, key short-term and long-term indicators, signaling positive momentum with a bullish trend. The stock's been trading close to its recent resistance at $190. If this resistance breaks, it will probably move up to test its all-time high at $210. The relative strength index is around 56, just above the neutral level. The stock's been making higher lows from quite some time, indicating a possible move towards its all-time high. The price is currently moving closer to the upper Bollinger Band, and the bands seem to be tightening again. Narrowing bands usually indicate a breakout in either direction in near future. For now, it would be a good idea to watch it break through either its resistance at $190 or support at $170. If you want to watch the full technical breakdown I did on Nvidia, then please click on the link somewhere at the top of the screen. All in all, the stock's been bouncing within the consolidation range of 170 to 190, indicating a breakout in near future. And until it does so, it would be hard to have high odds in your favor. I give their technicals a 7 out of 10. Does this technical setup have you feeling bullish or bearish on Nvidia? Please share your thoughts in the comments down below. Now, let's talk about the one thing that can send stocks flying or crashing overnight: market sentiment and psychology. There was a looming fear of an AI bubble for quite some time, but sentiment flipped positive after the killer Q3 earnings beat, sold-out Blackwell chips, and early buzz on the Rubin platform launching later this year. Big tech like Microsoft and Google are ramping AI spending to around $500 in 2026, fueling high demand. Media and Reddit are hyped. Nvidia is trending with positive vibes. But some caution is necessary as some still fear a bubble, with the stock trading at an overhyped valuation. Recent China-Nvidia export deal could add billions in sales, easing geopolitics worries, given that China doesn't ban all Nvidia chips. Wall Street is super bullish on Nvidia stock. As of January 16, 2026, 45 analysts cover it, with most giving a strong buy rating. Only a few analysts suggest holding or selling. The consensus price target sits at around $255 to $260. That means about 38% upside from current price levels. The high end, an analyst at Evercore sees $352 by the end of 2026. Lowest projected price is at $140. Overall, the crowd is excited and institutions are buying in. I give their current market sentiment an 8 out of 10. The momentum is strong but not perfect due to valuation risks. Moving on to final factor, leadership. Nvidia's leadership team drives its success, starting with CEO Jensen Huang, who founded the company in 1993 and has led it ever since after working as an engineer at AMD and LSI Logic, where he gained expertise in microprocessors and graphic design, which he used to transform Nvidia from a small graphics chip maker into the AI powerhouse it is today by pioneering CUDA software in 2006 to enable general-purpose GPU computing, and by envisioning AI factories that bundle hardware and software for massive data centers, while also pushing sovereign AI projects for countries building their own tech infrastructure, leading to explosive growth, with the stock up over 100,000% under his watch and making him a visionary icon in tech through his famous leather jacket keynotes that rally employees and investors alike. Next is CFO Colette Kress, who joined in September 2013, bringing over 25 years of finance experience from roles at Microsoft, where she handled Xbox finances, and at Cisco, where she managed global operations, which she has applied at Nvidia to deliver spot-on earnings guidance and to orchestrate key acquisitions like Mellanox in 2019 that boosted networking capabilities, while also overseeing massive shareholder returns, including over $100 billion in buybacks and dividends since her arrival, and expanding gross margins from around 50% to 73% through smart cost controls and pricing strategies. Then there's CTO Michael Kagan, who joined in 2020 through the Mellanox acquisition, after pioneering InfiniBand technology and serving Israeli army tech units, which has enabled him to advance Nvidia's AI infrastructure by integrating high-speed networking like NVLink and InfiniBand that now power 70% of the world's supercomputers, and by driving the roadmap for innovations like Rubin platform, set for late 2026, that promises 2 to 3 times more efficiency. Nvidia lacks a formal CEO, but operations are handled smoothly by executives like Deborah Showquist, the EVP of Operations, joined in 2007 as Senior VP of Operations and rose to EVP in 2009, bringing experience from HP Quantum and Coherent, where she honed supply chain and manufacturing expertise that she has applied at Nvidia to oversee global operations, including production quality and logistics, scaling output for AI demand like Blackwell chips amid shortages, while navigating supply crisis post-COVID to ensure timely deliveries and cost savings that support elite margins and rapid growth. Nvidia's leadership structure is notably flatter than many other large corporations, a deliberate choice by CEO Jensen Huang to prioritize speed, transparency, and agility. Their leadership scores a solid 9.5 out of 10. All in all, Nvidia has a bright future. It has all the key ingredients required to double their market cap in the coming years. They are perfectly positioned to benefit from the trillions of dollars of planned AI infrastructure spending. They have the right leadership to execute it all, including the founder himself leading the pack. Their product is still the most superior, rightly claiming the 90% GPU market share. And they have the revenue numbers to prove it all. The concerning thing is their overvalued market cap and the choppy chart pattern indicating a probable correction. The reason we assess these companies through 6 different angles is to try to get the best entries possible. Yes, we will make money if the fundamentals are solid and the future is bright like Nvidia has. But what if we can catch it after it corrects its price? Thanks for watching. I'll see you in the next video. Until then, take care and invest wisely.